it has just been announced that the Federal Reserve has raised the Fed funds rate another 75 basis points, which makes it the third 75 basis point increase in a row. That has taken the federal funds rate now to 3.25%, and that is a 3% move for the year. Coming from a very, very long time of zero interest rate environment, this is a lot of movement. Now, they still have said that they are going to continue with quantitative tightening. The total opposite of quantitative easing, which is very important. They need, in order to get inflation down, they need to keep taking liquidity out of this economy that they've been putting in through mortgage-backed securities and treasuries, and they need to keep staying aggressive with this interest rate fight. We are going to see how this plays out in months, because it's not like you raise interest rates and all of a sudden the next day inflation starts coming down. No, this is a month-long process. Now, the question becomes, because they're remaining as hawkish as they are they playing catch-up right now? Are they late to the party? Can they achieve this quote-unquote soft landing? Here's a couple of things that Jerome Powell said in his question and answer session that I really liked, and then we're going to get into some of the numbers off of their press release. So he did acknowledge the number of job openings. He said that there's a lot of job openings, and they have been living and dying on this unemployment number being so low. The unemployment number into 2023 is going to get to 4.4%. That is the projection that they're making. But he did acknowledge that there's a lot of jobs that are still out there, still open, and they are not being filled, which is a very, very important thing to understand. The demand is not in line with the supply overall in the economy, and that includes in the jobs market. Price pressures. We know that energy has been a very strong price pressure on the inflation number. Energy, meaning the gasoline, the electricity, etc. And those numbers have pulled back, but they do see them going a little bit higher in the future. And they did acknowledge, which I was very happy about, they did acknowledge that the prices now for gasoline are still significantly higher than they were in 2021. Prices have not been alleviated on things such as medical care, food, housing, rent, cars, etc. We still have all of these inflationary pressures, but I do like the semi-aggressiveness that they've gone after with the 75 basis point hike reduction. Now, what are they going to do going forward? They keep saying that they are going to keep trusting the incoming data. This has been a very, very consistent thing that has come from Jerome Powell for well over a year now, that they are going to wait for the data to come out, and they're not going to make projections into the future. They still have said that they want this inflationary rate to sit at 2%. Now, when is that going to be achieved? Based on these numbers right here, let's head over here. This is the release that they put out at 2 p.m. on Fed Day. Now, they have said that they are going to achieve this 2% inflation rate by 2025. What are the interest rates going to go to? This year, they expect those interest rates, the Fed funds rate, to get around 4.5%. So that is still another 1.5% to go over the next couple of meetings, which is a very, very aggressive rate and a big change from what they were saying previously. Into 2023, they're looking well over 4.5%. I mean, in some cases, they're looking at about 5%. And I'm going to pull up the dot plot in a second, which is all of the Fed presidents that get to put in their direction that they see that all of this should be going. And in the longer run, they do anticipate bringing interest rates past 2025, probably into 2026, 2027. They expect to bring those back to the 2.5% to 3% range, which is your normal range. It is not normal to be sitting in a range of a 0% interest rate environment. It is also not normal to be sitting in a range of somewhere around 5 or 6% interest rate environment, which could be the direction that we're going if things cannot be curtailed. Now let's scroll down here a little bit more. Real GDP growth, before we get to the dot plot, real GDP growth, you can see that we are sitting in that, and I wrote this in, this stagnant area. You notice where we are. There's not a lot of GDP growth happening year over year, which is not surprising for as large as an economy as we have. But we did get that massive spike coming out of COVID that the GDP growth grew so rapidly, say that 10 times fast, and we are going to get stagnant over the next couple of years. Unemployment, it's going to stay consistent. It's going to stay around that 4% range, and Jerome Powell was very, very clear about that. Now, inflation. Inflation, they are saying, is going to reach that 2%, and they are predicting that 2% happens around 2025. That is a very, very long time out. But with that being said, there is a lot of damage that needs to be undone, and that is exactly what they are doing. Now, here's the dot plot that I talked about. This gives you a target of all of the different presidents of where they think things are going to be down the road. And you can see this year, the majority of presidents think that we're going to sit somewhere in this 4.25 to 4.5 range. Going into next year, you have a lot of presidents saying 4.5, 4.75, 5% range. And then into the future, of course, they all come back towards this 2.5, 3% range. And that is going to be pretty much the area that we're going to sit. Now, did I highlight anything else in here? I don't think I did. It's a lot of just statistics, and you can pull that up directly from the Federal Reserve's website. It is nothing special. This is a 17-page document that they put out each time, and they go through and put their statistics on there. The question now that I ask myself and that I worry about for the future is the Fed going to stay as hawkish and aggressive on rates as they have been? Here was the issue that happened back in the 70s and 80s. They got extremely aggressive on rates, and what had happened? They got aggressive, they carried it up, and at some point they said to themselves, okay, we can ease off of rates a little bit and we can start this pullback down. And all of a sudden, they started to pull things back down, and they were already in a recession, they dipped into another recession. So that is what is called a double dip recession. Jerome Powell basically did acknowledge that a recession is expected, and that's based off of that 4.4% unemployment number. Typically, when you see those numbers, you will see some type of recession happening. And he really did say in the question and answer session, didn't say it in so many words, but he said there more likely than not will be a recession from this environment. What are they going to do? Are they going to stay as restrictive as possible, or are they not? My personal opinion is at some point, they are going to start easing up on rates, and it will be causing more headaches than we're sitting in right now. And I do think that just based on the credibility of this Fed, I think that we could start seeing a double dip recession. Now, is that a bad thing? Not necessarily. It's worse than a regular recession, but I've drawn this so many times. When you get this pendulum swing to these extreme highs or extreme lows of basically 0% interest rates, you have to swing in the other direction. When you have all of this quantitative easing coming into the economy, you have to swing to the other direction because of with quantitative tightening. Stick to your plan out there. If you're buying stocks or ETFs, low-cost ETFs every single month in your IRAs or your 401ks or your brokerage accounts, just keep doing it. You are going to be better off in the long run if you just stick to the path of just dollar cost averaging into your stocks. Put all of this noise to the side. Is it going to affect you? Yes. But you are also going to benefit, and probably have benefited, from the incredible run-up that the economy has done over the past decade. And if not just the past decade, if you're a new investor, over the past 2 years coming out of COVID, it has been an incredible economy, an incredible stock market. But unfortunately, what goes up must come down. Catch you on the flippity flop.